Hey guys, welcome back to Old Guy Talks Money. Today we're going to do a quick video and look at my options trades during the month of August. I started this back in April with my first in this series, and I posed the question, did I think it was possible to use option trading to generate additional income in retirement? So I really have been running an experiment all year. The results have been uh, really pretty good. August was a tough month. We'll see that. Saw my thumbnail. We've been trying to climb back from a little crash earlier in the month, but we'll show all that in a second. Now, as a quick refresher for those of you who may be new, I'm doing something called the wheel strategy. Really, it's pretty simple. Basically, the way it works is you have cash, you sell secured cash puts, trying to get into the market. So, you set a strike price, and based on the market price at the expiration date, one or two things are going to happen. That contract's either going to expire and you keep your cash, you collect the premium, and you go forward, or you're going to actually end up owning the shares and you get to collect the premium. All right, once you own the shares, then you're going to sell covered calls. So I own the shares. I'm agreeing to sell them at a certain price, a strike price on the expiration date if those contracts get assigned. You do that, collect the premium, one or two options. At the end, you will either get assigned and those shares will get sold, or they will expire and you start over. So it's kind of a wheel. You sell puts to get in the market, turn around and sell calls once you own the stock, and once you come back out, you start all over again. The whole time you're earning premium from the buyer of those either put or call options. That's the basic strategy. You'll see in today when I show you the numbers, during the month of August, we had both strategies going. In other words, both puts and calls, because you'll see where I came in and out. I did add two things to the spreadsheet this month. I did make it a little easier, add a column that shows where they were expired or assigned. I did it late in the month where I'm actually footnoting or adding a note to show the deltas. That's where I kind of the number that I'm using to try to help me decide what my strike price is. But I'll try to show you that in a second. So I think that kind of sets the stage. Let's pull up the Excel spreadsheet and we'll jump right in. So before we look at the Excel spreadsheets, I kind of want to illustrate something. I've said this a couple times, but I think it bears repeating. I believe from my experience that the wheel strategy with covered calls and secured puts really one of the safest strategies when you're trading options. You're not trading on margins, you're not borrowing money, you're not worried about spreads or anything like that. You either have the cash and you're trying to get in, or you've got the stock and you're trying to get out. I mean, that's the gist of it. The big risk, and this actually happened to me, and this is why I'm showing this, is that you're selling puts to get into the market, you get in, and then the market falls out from under you. So on 7/23, I actually had sold contracts with a 494 strike price, which meant I'm going to buy those shares if the market is under that. Because think about the other side of that. If they can get 494 from me, which I'm obligated to do, and the market is at 480, excuse me, it closed at 480.62. What are they going to do? So I went in at 494, and then look what happened after that. It went down, had a little bounce, and then way, way down. And at one point in time, I was down about $50. Excuse me, $50 a share. I think the lowest it went down was like 444, and I was at 494. Let me make sure I'm telling you right. Yeah, that's right. So what do you do when that happens? When you move to the sidelines, you hold the stock, wait for it to come back. And this is why I wanted to repeat myself. I would not do this, guys, unless you're willing to hold the shares for the long term. Now, I'm using QQQ, Exchange Traded Fund. It's designed to mirror the performance of the NASDAQ. Feel very comfortable doing this with this. Now, I may have to sit on the side, may not be able to trade till the market comes back up. And you can see we back up at 476 with what it closed at on Friday. I have been able to do some stuff with it. You'll see this in a minute. Just be aware that is the risk, and I did want to show that to y'all. Okay, so let's look at the trades I made during the month. Pretty active month. It's kind of unusual because the market was a little bit all over the place, and you saw the challenges I was facing with the queues. So the way I track this is, determine what month to include it in. Even though I may get the premium in the previous month, I always do it by when the contract expires. So you'll see the first four trades were actually placed in July, but because they had an 8/2 expiration date, I did include them in that month. So we talked about the wheel strategy. On 7/24, I had 300 shares of Truist. That's a regional bank combination of SunTrust and BB&T. This is one of those things where I had 90 odd shares left over. I cleaned up some of my portfolio, sold some single positions and individual stocks, freed up some cash, bought enough to get 200 shares or 210 shares. Each of these contracts is 100 shares. So I got enough to trade on it. I sold it with sold the contract call with a $45 stock price. I had a $42.72 basis. I made 82.50 on that. It closed at 42.12, and you can see that expired. Now let's think through that. When I'm selling a call, that's the price that I'm agreeing to let the stock go for. Okay. If it closed at 42.12, that's what they could buy it in the open market. They're not going to buy it from me at 45, so that expired. Now we talked about the queues. I had been on the sidelines with the queues since I went in. I decided to try and eke out a little bit. So 7:30, I placed an 8/2 trade, 200 shares. That's what I owned at a 4.94 strike price. Again, at this point in time, I'm just trying to get my basis back. Got very little premium. You've looked at some of my other videos. Usually, you're in the couple dollar range for the queues. So I made 24.97. Now this was one of those low risk trades. At that price, that strike price, this was not going to go, and you can see it actually closed at 448, so it had gone even lower. Also had puts. So remember how the puts work. I have the cash. I'm trying to get into the market. So in my taxable brokerage, I sold 5 contracts, 500 shares at a 43.50 strike. And my brokerage, my IRA, my Roth IRA, I had 700 shares or 7 contracts, both with a 43.50, closed at 42.12. All right, so think about the way puts works. That's the amount that I am willing to pay for the shares. Market's at 42.12. That's what the buyer of the contract could get. What would they rather do? They'd rather sell them to me at 43.50 as opposed to 42.12. So I ended up owning those shares. So normally I try to do this on Mondays. So the next Friday would have been like an 8-9. Well, market was all over the place. The premiums just weren't there. I kept looking every day, every day. Finally, on Thursday of that week, I went ahead and did place some trades on the Truist. All right, so I had essentially 800 shares on my taxable brokerage account. I had 700 shares on my IRA. Sold all those calls with a strike of $44. The reason it split like that was just the timing of when I made the trades, just trying to get a little bit better premium. You can see I got 11 cents, 8 cents, and 10 cents because these premiums move, throughout the day, throughout the hour. That's why if you'll look at that video I did where I show you how to place an option trade, I always use a limit. That way it guarantees an amount that if, you set your limit at, and let's use an example, say 11 cents a share, and the market goes down to 8 cents a share, you're not going to go in. That order will not fill. So it just gives you some protection because these things do go up and down. All in all, for that week, I had a high of 12.54 return, 12.54% to a low of 8.92. Not blowing it out of the water, making a little bit, just trying to eke out some. Again, I own the shares. I might as well try to do something with them. And as long as I'm comfortable with my strike price, there's no risk in doing this. All right, so let's go down to the next. All right, so those all expired on 8/16, so I still own them. On Monday of the next week, place the trades again, the same 800 and 700 shares respectively. strike price at 43.50. I will show you this. This is the delta. The delta is really, it gives you two things. One, it's a measurement of how the option price will change in relation to change in the stock price. But the other measure is chance of it going in. They call it a chance of profitability. So you look at some of the people that do this a lot on the YouTube, they say, stay around that 20% delta, which means that there's a 1 in 5 chance that the contracts will get assigned. So I did this at 43.50. See, I really wasn't making a whole lot here. I did make some gain of 264. I did get 13 cents per share in premium. So roughly a 15% return. Little bit better when you include the gain. Again, just trying to eke out a little bit of this to keep the things moving. Had a strike at 43.50. It closed at 43.84. Again, these were calls. They can buy my shares at 43.50 as opposed to in the market at 43.84. That's what they're going to do. And those shares got assigned. So here's the last week of the month. Now on 8/19, you know what the Qs had done. I showed you that on that earlier page, and I was way underwater. So I was able to place a trade. Now I had a strike of 495. I had 200 shares, so there was potential to make $200 worth of gain. Look at the delta, 0.122. The likelihood of this actually happening was very, very minimal. And the fact that I had gain built in, that's why I was, willing to roll the dice on this. You can see that we had come back some. I closed at 476. It did expire. I still own those shares. I will continue to watch the market, try to do a little bit something with them just to kind of keep something coming in so they just don't sit idle. The one thing I will not do, I will not sell below my basis. There's my basis of 494. There's just too much risk. The market can be really, really volatile. So what I want to do is make sure that my strike price is always at that or above. That means I will either break even, except for the premium I collect, or I will make gain. It's tempting when you're that far under the water to go, you know what, I can roll the dice, pick up a little bit more premium, sell it below my basis. But again, you get burned doing that and actually realize a loss. Even though at one point in time I was down about $10,000 on this whole block, it was unrealized. Until I sell it, it's just paper loss. So again, made 3% on an annualized basis. I mean, that's below high yield savings. But my thought process was we might as well do something and make a little bit. So that's what we did. All right. On Truist. Okay. Remember, I got taken out at the end of the previous week on 8/23. So I start the wheel strategy back over. So now I'm selling puts. Have 800 shares each in my brokerage and in my IRA. And the reason is just I had, in that Roth IRA, I had cash, but based on the share price, I didn't have enough to get 100 shares or one contract. Because the price was at 43.50, I actually did, because that thing's going up. Every time I collect premium in that Roth, the balance increases. I calculated it at the end of July, and that Roth IRA is up 25%. And I don't mean annualized 25%. I mean 25% since the beginning of the year, just because of using this strategy. All right, so strike prices of 43.50. That would be the price that if it turned out I would end up owning the shares at. I got 22 cents a share in premium, so made roughly, that's 340 some odd dollars. Had a really good annualized return there at almost 26%, and you can see those expired. Okay, so closed at $44. Let's think through how this works again. They can sell those shares in the open market at 44.06. They're not going to sell them to me at 43.50. That all expired. August was challenging. If you went back and looked at my previous videos, I can tell you through July, I had made roughly on average $3,000 a month doing this. Obviously, August, I really was not in a position to do that. But let's look at the numbers. All right, so roughly made a little bit here we go, $1,348 for the month. Not terrible, but definitely more than I had. Think about it. I mean, doing this, very little risk, and I came out with an additional $1,350. Number here, this total investment, don't think it's fair Even though the money wasn't in play, in other words, I didn't have contracts on everything for the entire month, I wanted to show what the total position was between Truist and the Qs, because I want to try to gut check what the overall return was. So on an annualized basis for the month, I made right at 8% without the gain. And if you factor in the gain, I made almost 10%. You know, when my high yield savings account's doing 5.25, again, just shows me that, you know, this is a viable strategy, very low risk, and I've been pleased with the results. So that's how August looked. I appreciate y'all hanging with me. Please hit that like and subscribe. It will help me grow the channel. If y'all are doing this, leave me a comment. Let me know what your experience has been. Are you doing the wheel strategy? Or are you doing some of the other more esoteric, you know, the iron condor, some of those crazy things that people do? Well, let me know what you're doing. So thank y'all for watching, and I will see you in the future.